Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. Welcome to a very special episode of our podcast. Sonu, it is Facts versus Feelings, episode 92. Here's our mid-year outlook. Just getting here in the last 30 minutes. We've had some adventures, Sonu.
No kidding.
Someone else on our team is recording. We had to go to a different recording right now. That's fine. But tell us, we've got a ton to discuss. I know people are here for a reason. But tell us, how did you get home in the last 15 minutes? What vehicle did you take? How's your morning going? Are you ready to talk about this? Or are you just ready to punch a wall?
It was supposed to be a good morning. I'm ready to punch my car, but I'll get hurt, right?
Yeah.
Car, I think it's like locked me out. Like, see, that's a problem with these electronic cars, right? Like, it's electronics, something's not working. I have no idea what the problem is. Back in the day, you could sort of hack it, put something, wires together, get the car going. You can't do that now. So, yeah, and here, my kids have to go to camp, right? So, the cheapest Uber, it just happened to be, it's not very expensive. It's like $13 or something. It's like those Uber Black things. So I get this massive Toyota Highlander coming, and that's what my kids get dropped to in school at camp, like very posh style.
Yeah. That's funny.
And normally they're getting dropped off in a Prius, like a little car here. This one is a big black SUV. That's what,
I mean, I forget this show. It was on Netflix, maybe within the last year with Julia Roberts, where all the machines go crazy and all the Teslas start crashing into each other. You're kind of reminding me of, we have to be real. I forget what that was called, but we have to be careful. But
kidding.
You know what, Sonu? Enough
at
of
least
that.
At least the Ubers are not, robo taxis. I promise you, I would not have gotten into a robo taxi today.
Yeah, I was in San Francisco back in April, and they're all over the place. I saw a video on Twitter/X, whatever you want to call it, where they pulled one of those over, and it was like the cop talking to.
Who are they talking to?
A robot of some sort. Yeah, I don't know. Anyway, all right. Well, let's get into it. Sonu. This is our mid-year outlook. People
eyes on the prize.
Eyes on the prize. That's where I wanted to start. I've got some thoughts on eyes on the prize. What does eyes on the prize mean to you?
Keep your eye on the long term here, right? Don't get, don't fall for little things that happen, every day in the market with sorry, I'm getting pings all over. I should put that off.
Let's turn that off. Yeah, take a second. Turn that off. Everybody loves talking to Sonu on a Tuesday morning.
Sorry, I just completely lost track of my thoughts here. It's already been a crazy morning.
Well, eyes on the prize. What's it mean to you?
Yeah, no, keep your eye on the long term. What's the prize here? Long-term returns, inflation-adjusted returns. What's the best place for that stocks? I'll just put it at that.
Yeah, and we'll put it like this. I mean, we've mentioned this before, but you think about just the last 7 years, what's happened? I mean, 100-year pandemic, multiple of 2 bear markets, a couple close bear markets, terrible wars, contentious elections. Believe me, the list goes on and on. We also saw the Dow double from 20,000 to 40,000 the last 7 years. So that's where, when we talk about eyes on the prize, there's going to be scary moments. There's always going to be something to worry investors. It's in our brains, back to the caveman days, to huddle up, when bad things are coming. And we should. We're not ignoring when bad things come, because they will. But again, eyes on the prize with all the terrible headlines. The last 7 years we've seen, Sonu, stocks have more than doubled in the S&P, the Dow, just 20 to 40,000. So, all right, let's get in. Let's start with the economy. Obviously people listen to this podcast. I kind of have a clue how we feel about the economy because we don't see a recession, but I don't want to go there yet. Just in the last 2 weeks, Sonu, we've seen some weak-ish economic data. You've been very correct. I mean, you and Neil Dutta over at RenMac, and maybe a couple other on a handful, were saying 18 months ago, no recession. How do you feel about some of this weak, recent economic data that we've seen?
It's not too surprising. At the same time, I do think it's more normalization. We've been talking about that for a while. At the same time, what does that mean? When you're in a normal normalized economy, the risks are higher, right? By itself. I mean, I think the economy is growing on trend. It doesn't take a lot for the economy to fall below trend. And once you're below trend, it doesn't take a lot for the economy to go into recession. I don't think we're close to that, just to make it clear. I don't think we're close to a recession anytime soon. The labor market is fairly strong. It's just not as robust, as red hot as it was a year ago this time, 2 years ago this time, right? I think that's what I'm seeing.
So exactly. I mean, maybe let's get into that because such a big part of why we don't see recessions, we see a strong labor market, right?
Mm-hmm.
And I want you to talk big picture about the labor market, but also, on Friday we had the jobs number came in. I think at 206,000.
206,000.
I make stuff up all the time. I was on TV yesterday for about 20 minutes. I'll tease it. But still, it came in better than expected. But you saw maybe, I don't know if cracks are the right word, but maybe some little issues with the foundation. Unemployment rate up about 4.1%. I mean, it's ticking higher. What you even said a really good note to our partners that there was some good and some bad in that in that employment data. What'd you find?
Look, two things are happening. One is net employment growth, so payroll growth. That's running really strong, right? 206,000, that was above expectation. The expectation 190,000. Now, we did get revisions, and that's why you always want to look at the 3-month average, something like that, right? That's running at 177,000. That's really strong by itself for comparison. Before the pandemic, I'm sure people who've heard us before have heard us say that. In 2019, the average monthly job created was 166,000. We're 177,000.
I was going to guess 163. I do this with you all the time. I knew it was somewhere around there, but anyway,
it's right
still,
there.
Yeah.
So, and I'm going to use this word net. Net employment growth is strong, right? I'll come back to why I'm going to use the word net. But let's go to the unemployment rate. That's where it's easy to look at. I think it's actually probably one of the best indicators whether you're getting close to a recession, to be honest. I mean, maybe initial claims for unemployment benefits is a leading indicator, but the unemployment rate is one of the best there is, right? It doesn't get really simpler than that. And that's going up. It's at 4.1%. A year ago, this time, it was 3.7%. So we've gone up. We've gone up very slowly.
Let me just jump in. I think in this cycle, we bottomed at 3.4, correct?
3.4,
pretty
yes.
sure. Yeah.
Yes.
Okay.
So, when you think about that, well, we are, 0.7 percentage points above that right now. Right?
Yeah.
If I did my math right.
Yeah, I think so. I think that math is right. I know it's been a wild morning.
So here's the thing. Now, here's where I'm going to put the buts and stuff like that. Let's go back to the net employment figure, right? Why is net employment strong? Net employment is hiring minus separations, right? Hiring has actually eased a lot. Right? And I'm talking about overall hiring. The overall hiring was about 3.6% as a percentage of the labor force. That's below where it was before the pandemic. Before the pandemic, it was 3.9%, right? So that's come down. So which means, is that really weak? No. Is that really strong? No, as well. And why is that? I think what happened is companies hired a lot of people in 2021, 2022, into the early part of 2023. They're like, okay, we don't need to hire many more people, right? But then you get to the other part, separations. There are two kinds of separations: voluntary separations, involuntary separations. Voluntary separations, people quitting their jobs, like you did maybe 2 years ago.
2 years ago,
that's and Ryan's not quitting now, fingers crossed. But look, there are a lot fewer people quitting their jobs now. People are more or less happy with they are. And usually what happens is, if you're in a recessionary state, the quit rate would be really low. Why? Because people are scared to quit their jobs. Right? So we're not in that position anymore, nor are we in a state of the labor market where everyone's quitting their jobs left, right, center because they can get a higher paying job across the road, across the street, whatever it is, right? Then you have involuntary separations, layoffs. Layoffs are running really low. It's running about 1% of the workforce. Before the pandemic, it was 1.2, 1.3%. So this is essentially why net employment growth is very strong. You have soft hiring, but you have very low quits, very low layoffs.
I got all choked up there. Had to go on mute. Listen, yes. I mean, quits are running about 1%. They're 1.2 to 1.3% pre-pandemic.
Layoffs.
Yes, layoffs. Apologies. Thank you. So again, there are some maybe some signs. Layoffs have kind of perked up a little bit, but the labor force is a lot larger than it was 5-6 years ago is an important concept. So, again, so this all comes down to the labor market is slowing, probably more normalizing is a way to put it. We're going to get into inflation, but to keep this high level, I should have mentioned this. I'll mention it now. You can go to carsongroup.com/outlook. And you can find our mid-year outlook right there, carsongroup.com/outlook. Also, we do have a email, facts versus feelings, versus is VS, facts versus feelings at carsongroup.com. We've started to receive some emails and some questions and some comments in there. So we're not going to answer any today because we wanted to totally focus on our outlook, but thank you for the people that have done that. So continue to send any comments and questions in. And we got some really good questions, some ones I had to think about recently. All right, so let's a couple more minutes on the economy, Sonu, because we do have a lot more to get into. Where do we want to go with this? I mean, talk to me about the consumer. If there's a lot of jobs out there still, consumer balance sheets are still pretty solid, and that probably says no recession, right?
Right. Balance sheets are strong, and balance sheets are strong across the board because when stocks have gone up, real estate has gone up. People in the higher, more wealthy households have relatively more stocks, so they see the bigger benefits there. But real estate prices, home prices have gone up, right? And at the same time, people haven't taken a lot more debt. I know we hear a lot about credit card debt, things like that, but people haven't taken a lot of debt, especially after normalizing for income. Right? If you normalize for income, debt service especially, because that's what matters, right? Yes, you can take a big mortgage, but ultimately what matters is, can you service that mortgage? Can you service the debt you're taking? And that's related to income. So if you look at it as a ratio of incomes, it's running below where it was, in 2019, right? It's much lower than what we've historically seen back in the 2000s expansion, 1990s expansion, all of that. And that gets to the income side. Income's also growing faster than inflation. I think that's the story there.
Yeah, that's one of my favorite charts. I know our friends at Yahoo asked us to send a chart at the middle of the year. They do an amazing chart book. Josh Schaefer over at Yahoo. A shout out to Josh. You're not following Josh on X, you should be. But he's asked that, and I said that was one of the charts. That's chart one of them we're sending, is the fact that, listen, inflation, if you look at PCE, the Fed's favorite measure of inflation, it's up, I believe, 19%, Sonu, since the end of 19 or early 20. Maybe it's Feb at 20 where we started.
End of 19, from December 2012, from February 2020,
I thought it was February 2020, right before the pandemic. 19%, no one's happy about it. No one's excited about it. But then you look at incomes and wages and compensation, they're all growing ballpark 24, 25, 26%. It's not a perfect world, but again, that is a huge reason why we continue to see an economy that, honestly, I think surprises to the upside. All right, let's see here. So let's go to inflation and Fed. This is kind of part two of the economy conversation. Because again, economy, we don't see a recession. The second half of this year is how we're going to put a stamp on that. Inflation keeps coming back a little bit lower. The PCE, we did talk about this recently, but PCE came in a higher, I think it was 4 months in a row. And not this time. It's 0.1 month over month. We talked about it last month. But again, one of the cool charts in our Outlook, again, carsongroup.com/Outlook, you break it down by 178 components of PCE. What are you seeing in there when you kind of peel back that onion on inflation?
We've made a lot of progress, despite that Q1 inflation data, which is harder than expected. And I think spooked the Fed as well. Right, from pulling back, like, oh, maybe we shouldn't talk about rate cuts this year, right? I think a few Fed governors went into that camp, but then we got April data, we got May data, and we're back on that disinflationary trend that we saw in the second half of last year. I mean, what 30 to 35% of all items are currently all items within that core PCE basket, 178 items, are seeing prices fall, deflation. Wow. Right? 35%. Before the pandemic, it was about 25 to 30% or so. So the prices are coming down. Is it coming down as fast as we'd like? Probably not. But we are making progress, right? We're making a lot of progress. In fact, I would say, goodness, right, I think the inflation problem is over, right? CPI is going to come out this Thursday, I think. Yeah, this Thursday, CPI is going to come out. And it's going to show, headline and core CPI is running about 3.5%, something like that, right? But I think you and I have talked about why that is. Shelter's made a big
shelter. I think I was on CNBC yesterday. I said shelter. It's like,
that's it. So you take that out, and then a few idiosyncratic things on the CPI side. It's auto insurance that's playing catch up. Pandemic effects. And then on the PCE side, stock prices are up, so portfolio management services are higher. That's pulling back as well. hopefully the stock market doesn't go into a bear market. I was going to ask you about that, but we don't think
that's
so.
Next. That's next.
That's next.
Yeah.
But now as long as that doesn't happen, I think inflation right now is running about 2.5%, to be honest. So which means it's, I don't think it's like, oh, the last mile is so hard. We're running at 3%. It's so hard to get from 3 to 2. No, I think we're already very close to 2%. I don't think we're below 2%, to be honest. I think it's somewhere between around, let's say about 2.2, 2.3%.
Yeah, and the bottom line here, then, what does that mean, or what's that mean to everyone out there? Well, we've been talking about it on this very podcast, so we think, hey, we'll say 2 months ago, like people were saying there'd be no cuts this year, might even be some hikes. We pushed against that in some of the models that we run for our Carson partners. We actually added long-term treasuries, long-term bonds for the first time in 2 years. At least I've been here, and long time for you as well.
Yeah,
because we thought that pendulum had swung way too far, and since then bonds have done pretty well. We'll talk about bonds here in a little bit, especially longer-term bonds, because the realization that, oh wow, there probably are 2 cuts coming. I think the chance of a cut in July is like 80%,
or in September. It's about 80%. But I don't think the chance of a July cut is 0% at this point.
Right. Well,
so I'm not expecting it, but I don't think it should be 0%.
I'm not either. I know Neil Dutta is out there. We trust Neil. We listen to him. He's saying they should cut in July. We probably would say they should also, but that doesn't mean they're going to. It's all about the messaging and things like that. So we think they're going to set the stage for at least 2 cuts the rest of this year from the Fed. And I guess the bottom line for investors is, listen, what's going on this year? Well, we don't have a really, by the way, a year ago right now, Sonu, was the last hike, right? So for a year, you could say we had this hawkish Fed. Obviously, very aggressive Fed. But for the past year, that hasn't been the case at all. So we've transitioned from a hawkish Fed. I don't know if we're going to call this an outright dovish Fed, but I'm just going to say it's not a hawkish Fed anymore. And that's probably why one of the reasons stocks are at all-time highs. Do you agree there?
No, absolutely. And look, rate cuts are coming, right? 5.5% is very tight. And Powell said it. Powell was at the ECB forum in Sintra in Portugal last week. As we speak, I think he's front of the house.
Yes.
Yeah, he's front of the house. And what is he talking about? He's saying the risks are dual-sided. So they have 2 mandates. They have to keep low and stable inflation. That's one part of their mandate. The other is stable employment, right? I think,
which, by the way, I'll just jump in. It's neat. It's like goalposts, because we just had the jobs number. Now we've got Powell talking, and in a couple of days we've got inflation.
The CPI,
so you got the CPI and PPI, but CPI is the one we all look at. But you've got Powell in the middle of these 2 things, and those are the 2 things he should care about. Not who's in the White House, not how earnings are going, not how great this podcast is. Maybe he should care a little bit, because we've been probably more right than him in some ways. But nonetheless, that's what matters. Go ahead. I just want to jump in and point that out.
No, look, and exactly those 2 things, right? He's saying the risks are 2-sided right now. Right? If they act too quickly, he says they're at risk of undoing all the inflation gains they've made over the past year. Inflation's come down. They're worried about inflation going up. But at the other side, the employment side, he's saying the risks have increased there too. If they act too late, they could break this expansion. What he said is there could be an unnecessary slowdown, unnecessary recession, right? That very word unnecessary itself tells him that, you know what, we should probably act sooner rather than later, because we don't want to break this expansion. We have a good thing going here. Let's keep it. And this is not what he was saying a year ago. A year ago, the risks were all one-sided, right? They weren't talking about the labor market risks at all. They were talking about, the risks are all about, inflation rising again. We need to keep rates tight. Not anymore. That's a big difference. The risks becoming 2-sided here.
And let's remember, jobs were 300,000 ballpark, a year ago, 400,000 2 years ago. So they've slowed down. That's why the risks are 2-sided. All right, so we've covered the economy, we've covered the Fed, we've covered inflation. Let's go to stocks. Let's go to stocks next. So
do we have a target?
Yeah, we do. I have to raise it. I have to raise it tomorrow. We sometimes have to do these targets a little bit earlier than we want, but it is what it is. We have a target on the S&P the second half of this year between 17 and 20%. You could argue we're ballpark right around 16, 17% as we speak. So I think the risk to our entire outlook, if you want to ask me what the risk is there could be more upside. Now, fortunately, we are overweight equities. We manage real money. Listen, I'm not a big fan of my target on the S&P is this number. Believe me. Then you hit it, and are you bearish now, or are you not? So, we are still quite optimistic on stocks, still overweight stocks. We'll talk about how to create a portfolio here in a little bit on how we're looking at the world from a portfolio point of view. But we've got 17 to 20% right now, Sonu, on the S&P 500. Some things to think about that I think are pretty interesting. Talked about them briefly last week, but I'll do it again. When you're up at least 10% the first half of the year, like we were on the S&P, up about 15%, give or take. The rest of the year is higher 83% of the time. An average return of right around 8%, median of almost 10% return. That's just one way to look at it. But I guess the thing that I want to stress, and you've said it many times, momentum begets momentum. There's a lot of momentum, just not a recommendation of any individual stock here, but
Right.
Tesla up 9 days in a row. NVIDIA has kind of dropped off a little bit. I mean, it's still an all-star, don't get me wrong. But you got Tesla up 9 days in a row. That's a healthy market. And I get it. The top 10 stocks are very, very large. We understand that. But we're still seeing lifeblood of a bull market is rotation. Final thing, Sonu, I'll bring in. Okay, we know tech did S&P up 15%, Dow about 4% middle of the year, small caps about flat, NASDAQ up more. I think it was 18, 19% at the midpoint of the year. Where's it going with this? I don't know where it's going with that.
Momentum for sure.
I know. Yeah. I know where it was. Sometimes, just start thinking. There's 11 S&P 500 sectors. Only one is down on the year. That's real estate. All the other groups are up. Now, believe me, some aren't up as much as you'd like. Industrials, I believe, around 7 middle of the year. Financials around 9. Those are some groups we think are going to do good. You've got.
By the way, 7 and 9 are not bad numbers for half a year, right?
No, I mean, at the middle of the year, the S&P 500 averages a 4.2% return. Okay, a great stat for friends at Bespoke. Again, huge fan of Bespoke. We quote them all the time. If you take out the Mag 7, if you take out NVIDIA's gains, you're up about 10% for the year. Not that bad, okay? If you take out the Mag 7, you're still up like over about 4 to 5%. That's still a better than average year if you take out all the stuff that's winning. I mean, think about that. So again, yes, there's some big winners this year. We get it. We think that, again, there's going to be more rotation, a little bit. Some of the other areas are going to do better, not just tech, not just communications, but we're still overweight communications. We're still even weight technology. It's not like we're saying we don't like those areas, but there's a lot of opportunity there. So one more thing for me, I can go all day on this stuff, and sometimes I do. The time we're recording this, the S&P 500 is up the first 5 days of July. That's like the longest winning streak to start of July since 1989. Last month, if my calendar is right, was June. June stocks did really well last month. I don't have the exact number. You know what the S&P did last month? Ballpark?
Probably about 4%, yeah, 3
something or 4, like that. I mean, that's on the heels of a 5% May. Okay, but just think about this: how crazy this was. June, the worst day all month for the S&P 500 last month was 0.1%, 41 basis points down. Okay, that was the last day of the month, by the way. I mean, you got to go back years and years and years. That's for any month, but that's the worst day ever for June. I got 1928, so how far back that data goes. I mean, that is just incredible. I think my question to you as I continue to rant, but hopefully people like some of the stuff I just said. We've been spoiled, man. We have been spoiled. Okay. Remember last year when everything was going great, you and I had bullhorns on when Tom Lee joined us right about a year ago. I said, God, we just marked the top. We did. We marked the top before a 10% bull market wearing bullhorns with Tom Lee.
That was last July.
End of July, right about a year ago. Wow. So I think, again, that people just need to remember that in an election year, September and October are pretty darn bad months. I wouldn't be surprised again, Sonu, if after this huge rally we've had, we had some volatility. It's normal. It happens. Eyes on the prize. Don't get too worked up on it. But volatility will happen eventually. We've been spoiled. Don't get me wrong. We're not complaining. We've been overweight equities. It's been a good run.
Since you mentioned just one thing.
Go ahead. You talk for a while. I just went all off the rails. You talk for a while. What do you want to say?
No, I was just going to say, since you mentioned like last year, it just struck me that, last year is when we wore those ridiculous bullhorns, which I don't know where they are.
I think I literally said this is probably a near-term top, and to the day, like July 31. I think we recorded like July 30. July 31 was the peak before the 10.2% correction into my birthday, October 28th, and then the end of the year rally.
But keeping your eyes on the prize, this gets to looking back 1 year, the return for the S&P 500, 27%.
Right. Since the Fed stopped hiking, up 27%.
27% since last July through today, right? 1 year ago. So it just gets to like keep your eyes on the price, right? And of course, giving ourselves a little pat on the back here. But momentum, it gets back to momentum. But the other thing, right? It would be one thing if all of these records it's been one record after their record high. How many have you had? 34,
Went to
35?
35 at the time, which extrapolates out to just under 69 all-time highs, which would be, I think, the third most ever, maybe fourth. I'm not sure if we're going to hit that. CNBC asked me yesterday, you think we're going to have 70? Probably not. I might have a little, not quite as much, but hey, we've still got some more coming is the way I'd answer that.
Now, what would be worrying about all this is all of this is coming on purely sentiment, and by that, you can measure it, right? Easiest way to measure it is are multiples going up? Are people willing to pay, much more for future earnings than they were willing to previously, right? And turns out, at the end of the quarter, end of June, so half year mark, the S&P was up about 15%. Only about half of that came from multiple growth, from valuation growth, PE, looking at forward PEs, right? Price earnings ratios. More than half of it, was from earnings growth plus dividends. Dividends is about 1% or something like that, a little under that.
Okay.
Most of it is earnings growth. And most of what is driving earnings growth, you can break earnings growth into sales and margin growth, right? We know nominal GDP is growing around 4.5%, 5%. So sales are going to be strong. Sales growth is going to be strong. But companies have a lot of operating leverage. I remember I talked about companies are not laying off people. They hired a lot. These people, the workers they hired are getting better at their jobs. Hopefully, like you and I.
Well, the way this morning has gone, we have some room. We have, if you guys only see how the sausage is made, we've got room for improvement, I guess. But we're doing all right. We're doing all right. Yeah.
But companies have a lot of operating leverage. What does that mean? That means when sales go up, it can increase margins. That's essentially what's happened. That's what we saw in the second quarter. Margins went up a lot, right? And that's what's driving, I think, the index to record highs day after day after day.
Well said. If you want to hear if you want to hear the latest from us, don't forget to subscribe to our podcast. You can also leave a review. We love your feedback. All right, good stuff there, Sonu. What else? Anything else? Would you? There we go. How about this? How about a portfolio? Let's talk real world with our listeners out there. We're overweight equities. Okay, that's great. How are we positioning portfolios? How we suggest someone position a portfolio for the next 6 months? What do you see here?
So we like equities. We're overweight equities. I mean, we've been in the camp. We are overweight the U.S. We think the U.S. was doing better than other countries. We've seen that the proof's in the pudding too. But that's been our base expectation, right? And then we do think small and mid caps. I know they've struggled over the year, but you have to at the end of the day have a diversified portfolio. Right. That's not to say we're negative on technology. And I think, like you just mentioned, we're neutral on technology. In fact, if you open up the hood of our portfolios, what's the biggest sector in there? It's going to be technology.
Yeah, it keeps going up, so that's why. But yes, it absolutely is.
Then the question is, do you want more of that? Right? And I think then that gets back to you want some portfolio diversification. You and I mean, look, we're not expecting a bear market here, just no question, right? But I think I was looking at I mentioned this yesterday on an advisor call. Large cap tech stocks ran up during the dot-com bubble, right? And then you had a crash. You had a bear market, 2001 to 2003, or 2000 to 2003. It was just 3-year bear market, right? Small caps actually didn't do too bad. Mid caps didn't do too bad. Value coming to like the king of value, Warren Buffett. Berkshire Hathaway actually did 30% over those 3 years. Positive.
So I live in Cincinnati. P&G, not a recommendation. Good old P&G. I mean, the boring old P&G. They did really well during those years.
Exactly. So which is why you want a diversified portfolio. You want to be prepared, right? In case something turns in one part of the market. And that's always the case. Like you've said, rotation is the lifeblood of the market. So you want to be positively exposed to that, right?
Yeah.
And then the other side is, okay, we're overweight equities. But like I said, the risks have increased. Powell's saying that the risks have increased as well. Like, you take him at his word. I do think the risks, I don't think risks are balanced between inflation and the unemployment. The employment picture, I am skewed to the fact towards the employment side a little bit. I think there are more risks of something breaking there. I don't think anything's broken yet. But how do you hedge for that in a portfolio? Well, that's why I think you already said it. We increase duration. Right? If we do, say if you're wrong, if you do have a recession, something goes awry, so we get an unexpected shock, right? That's not predictable or that we don't see on the horizon right now. But let's say that happens. What do you want in your portfolio? You want the safest asset in the world. That's long-term U.S. Treasuries, right? Or U.S. Treasuries generally. But we think if the Fed's reducing rates, we already think they're going to go from 5.5. By the way, we talk about 2 rate cuts in 2024, but it doesn't stop in 2024. They're going to have a meeting in January, right? By January of 2025, we could see 3 rate cuts. By March, we could see 4. So suddenly, instead of 5.5%, we're at 4.5%. But let's say we're wrong about a recession. So let's say I'm wrong about everything I'm looking at, right? I missed something. Yeah. And that's why you want to hedge, right? And instead of 4.5%, they have to take rates down to 3%. What's going to give you the most juice in your portfolio at that time? It's going to be long-term treasuries, right? And that's why we have that.
Well said there. Now, I don't want to get too in the weeds of this, but we also like alternatives a little bit in a portfolio. You want to talk briefly about that?
Yeah, we like liquid alternatives in the form of like managed futures. And that's the other side. Like, say we are wrong about the recession thing and things go awry. That's why we have long-term treasuries. But say we are wrong about inflation. Let's say we have an energy shock, right? We saw that, we've seen that before. Say oil prices, we don't think this is the case, but let's say oil prices, for whatever reason, jump to $100 a barrel, 110. Suddenly, we're talking about more inflation again, right? And that's why you want what hedges inflation the best, especially over shorter time periods, things like managed futures. And that's why we have that in the portfolio as well. So we are protected. We think the risks are higher, and that's why we're protected on both sides.
Right. I mean, if you listen to this podcast, last year we were quite bullish. We just talked about, heck, we had bullhorns on with Tom Lee a year ago.
And we didn't have these hedges, right? We had mostly cash.
That's what I'm getting at. We didn't have hedges. We didn't have long-term bonds. We were telling you week after week, listen, stocks are probably going higher. You want to own some stocks. Fortunately, that played out. Now, again, some risks are popping up, but that's just the way this works. I mean, I should have mentioned this. I can. I kind of bring this full circle on stocks. This bull market's only 21 months old. I'm going to say only, air quotes here, But listen, your average bull market, Sonu, 61 months, okay? Did I say weeks? 21 months. I don't know if I said it. I think 21 months. Yeah. I don't know who knows what I said. But since October of 22, okay, it's about 21 months for this bull market, okay? Almost getting close to 2 years old. But your average one lasts like 61 months, okay? So
wow.
No such thing as average. We understand this. But again, just the idea that this could continue to go a little bit further, maybe a lot further than people think, is kind of where we are. We're still bullish. But again, after 21 months of a rally, hey, some bull markets ended around then, okay? We don't think this one's going to, but that's why we are positioning our portfolios that we run for our Carson partners and for their clients. That's what I think is cool about our podcast. We're not just pontificating about things. We're talking about how we see it, but we manage real money. Our team manages real money. Billions of dollars, put a lot of time and effort into it, have fun doing podcasts, trust me. But again, it matters what we're talking about. That's why I think Facts versus Feelings is hopefully one of your favorite podcasts, because we're not just making stuff up. We're managing real money around here. All right, so anything else on a portfolio or stocks? Because I know there are a few more things we want to talk about here.
No, I'll just underline everything. I know I spoke about both sides of like hedging both sides, right? Both risks. But at the end of the day, we like stocks. We're close to our maximum overweight in stocks. We're not even hedging. We're close to, I'll repeat that. We're close to our maximum overweight in stocks.
Good point. Excellent point. One final thing. It's an election year. Won't spend too much on the election. We've talked a lot about the election. We're going to talk a lot more about it as we get closer. Just know the second half of the year. Yeah, I don't know. Maybe not. My goodness, after what happens at the debate, we'll just leave it at that. But nonetheless, just be aware. We've shared this a lot. The second half of the year, an election year, stocks usually don't do that well. That's because 2000, 2008, 1960 skewed things. Those were presidents that were lame ducks. When you have a president up for election, Sonu, the second half of the year is usually really strong. Okay, now we've had a really strong first half. Actually, like the first, I don't know if I mentioned this or not, best first half in election since 1976. Okay, this year, just a hair under 1976. What happened after that? The second half of 1976, S&P up like 3-4%. So not a lot, but a little upside. So just kind of be aware of that. But again, we'll get a lot more into the election as we go forward. I did see a headline. Okay, break this up a little bit. A headline, it's like Market Watch, I think. Love Market Watch. I'm a big fan. They quote me a lot. I mean, I read it all the time. The headline was something like, why McDonald's stopped selling salads. Do you want to take a guess why McDonald's stopped selling salads, Sonu?
You had more people like me going to McDonald's.
They said, because people don't go to McDonald's to eat salads. I just laughed. It was the CEO, whoever it is. He's like, yeah, we realize people don't come here to buy salads.
Duh.
You need... I mean, how big of a marketing department do you need to know? That's like Baskin Robbins. People don't want like light yogurt. Oh, you don't say. They want like real fattening ice cream.
I have to say, if you go out for a burger or something, my wife is vegetarian. She just doesn't come. right? If she wants a salad, she's not going to McDonald's or Shake Shack or whatever, or Cheval over here. Like I'm going by myself or with a buddy or something. Or if you're in town, that is what
tomorrow I'm in town.
Yes, there we go.
That'll be fun. But anyway, I thought that was funny. They stopped selling because no one's buying them. You don't say. No one's going to buy. I mean, a few people probably like McDonald's salads. I get it. I actually kind of like McDonald's. I grew up on McDonald's. My kids don't really like it. They're snobs. They like Chipotle and Panera, like the fast casual that costs like $90 for all of us to go eat. Man,
so it's a preference for a bowl versus a burger. Is that what it is?
I guess so. But I tell you, people like their McDonald's. It's a good company. Not a recommendation on the stock. Anyway, there we go. All right, so what else do I have here? Oh, election. I guess a little bit more on the election. I mean, we've talked a lot about this stuff, but just know that a split Congress like we have now, like we probably expect to see, when all is said and done, I guess November 5th, the election? I don't know.
November 5th, yes.
I've kind of like blocked out. I don't know. So like November 6th or 7th, whenever we get the final results, we're probably going to have a split Congress, or at least pretty even, I guess you could say. The last 12 times, Sonu, when the S&P 500 has been higher under a split Congress, this year is probably going to be lucky number 13. Those are things that I think are important. Libby Cantrell over at PIMCO, we're huge fans. She's been doing some incredible work on what's going on in the election. We've got Libby coming up in a couple months on the podcast, so we'll talk a lot more about the election. Just know that we're not overly worried about this election because the economy is still strong. So let's just end it with that. I'm looking at the time. I know we're getting a little long. So we did already talk about bonds a tad, but I want to talk about the idea of higher for longer. So a little bit more on bonds. You've already touched on, but what does higher for longer mean when we talk about that?
We think, simply put, we think the economy is going to be pretty good over the next several years, not just this year. So if you broaden the horizon to the next 5-7 years, we think it's going to be a strong economy. We wrote about this in the full year outlook, the 2024 outlook. So seeing eye to eye. And what's driving that? We think productivity growth will drive that. But at the same time, when you have stronger economy, stronger productivity growth, an economy running close to capacity, you get more inflationary pressures as well. At the same time, you could get more inflationary shocks. Doesn't mean we think inflation is going to run at 2.5-3% over the next 5-7 years, but we think inflation could be more volatile. That's another reason why we like things like managed futures for a long-term portfolio, is to hedge against these bursts of inflation that we may see, right? I don't think we're done with that. I just don't think we're going to see anything anytime soon. But say 2 years down the line, right? And that's why we think rates are going to be higher. Like in the last cycle, they increased rates in 2018 to about 2.5%. And the economy is like, oh my God, we can't take it. Markets are like, Powell, you need to drop rates. And they started pulling rates back. This time we're at 5.5%, and there are people suggesting that, the economy can live at 5.5%. I don't think so.
Right.
But I think the economy could live at 3.5%, 3.5 to 4%. I think that's essentially where we land, assuming we don't get an unexpected shock or recession, anything like that.
You mentioned the word productivity just in the last, 2 minutes or so. My daughter, she's in Virginia Beach, and she's called. I go, okay, I can't answer it. So I'll text her. What do you need? She's like, I need money. You might be shocked. I hear from my daughter once a day, and it's to send her money on Greenlight. So I just sent my daughter $40 on Greenlight while you and I were talking. I mean, seriously, it's half of a joke. But how about that productivity?
So you haven't given a credit card yet?
Well, no, she's a Greenlight credit card. She's a Greenlight credit card, and that's is for parents out there. I don't think they're publicly traded. I don't know, but again, I always have to say not a recommendation. But Greenlight's awesome for kids. She's like, send me money, and I can send her the money. I know exactly where she spends. I'm like, oh, okay, she's at Panera. She's at here. Okay. She's 16. She drives around, spends money all over the place. So I track her by where she spends money on her Greenlight credit card that I control. But it's half of a joke, but it's really true. Like, I just sent my daughter some money while you're talking on a podcast live. Right. I mean, that's productivity that we didn't have. 10, 5, 20 years ago.
And you're keeping your daughter happy. That's important.
I'm keeping the economy going, Sonu. She's going to buy probably $30 worth of Starbucks. I mean, that's what she does every day. Anyway. All right. So higher for long. Anything else you want to put on higher for longer there? You feel good about that?
I think rates are going to be, just because we think the Fed is going to cut rates doesn't mean we think rates are going to zero. I mean, that's essentially what, higher for longer. We just think the steady state here is going to be about 3.5%, maybe somewhere between 3.5-4%.
Okay, got it. So listen, we are so proud of our mid-year outlook. We hope everyone listening to this podcast checks it out. Again, carsongroup.com/outlook, or wherever social media you follow Sonu, myself, or Carson Research. But it takes a village. So many people have helped us, and I can't list everybody, but Chelsea, our producer here, has helped so much. Graham, give you a shout out. Like this morning, it goes live. I noticed a couple tweaks, like, oh, Graham, do this, do that. I mean, people on our team have jumped, and it's not, we write it. Our you myself, Barry, we kind of wrote it on our team, and then we don't see it for about 2 months. And everybody does all this work behind the scenes. We're doing a special live webinar also. I guess we should promote that. I guess we can promote it.
Tuesday
the 17th.
17th,
1 p.m. Central, 2 p.m. Eastern. Again, you can sign up for that, carsongroup.com/outlook. Scroll down a little bit. There's the white paper there, right down there. We'll do a live version. Honestly, if you listen to this podcast, maybe you don't need to join. I hate to say that. Maybe I shouldn't say that.
But you'll see some charts.
You'll see the charts. That's right. You don't have to look at our ugly mugs. You can see the charts with what we're talking about. That's why you want to join us. And at the just sign up. We don't even care if you go. Just sign up. We judge it by how many people sign up. So go ahead and sign up. Do us a favor. Sign up your friends, sign up your grandma, sign up everybody. There
you go.
I was gonna make a joke about election years. If you got somebody dead, sign up them. I'm not gonna do that. I'm not gonna say that. But we do like.
We didn't say that. Scratch that.
We didn't say that. We didn't say that. But we just like sign up. So go ahead. All right. So the last thing, because I think this is kind of what I think about a lot with these. We've been right. Big deal.
I thought you were going to ask me about my car, but no.
No, that'll be next week's podcast. We're going to string this out forever. Where are we wrong? Where's your biggest area you think we could have a mistake? And maybe I'll answer first, and I just hit you with this. I think stocks do better what our target is. I mean, but stocks have gone up a lot. We're still bullish. If there's anywhere we could make a mistake, I think, we could be looking at back-to-back years of 20% gains. We mentioned at the start of the year, only once in history has the stock market gain, or the S&P gained 20% for the year, more than 20%, and been better the next year. I think it was 96, 97 or 97, 98, somewhere around there. I mean, listen, we had 24 point something percent, about 25%. I don't think we get quite that high, but I think we could be up a little bit more than 20% when all is said and done for back-to-back 20% years. I'm not saying that's a good problem to have. Again, we're over at equities. We can live with it. That's one area that I think we could be a little off with some of these calls. I'm not saying we're off, because I don't want to say that, but where do you think
the risk is to the upside?
Where are the risks?
Yeah, the risk. The way you put it is nicely, is like the risk is to the upside from your perspective. And I like to think hopefully we're positioned for that. With, like I said, we're max overweight equities, right?
I hope we are too, my friend. I hope we are too. I hope we're wrong.
Like
let this thing keep going.
We run unconstrained portfolios, which can go 0 to 100. It's benchmarked against a 60% stock, 40% bond portfolio. Right now, we are at 90% equities, maybe slightly higher if you look at equity exposure. So hopefully a position for that. Where I think we could be wrong, we may already have. I don't want to say we may already have, because, we look at these things over longer time horizons. You probably know where I'm going with this. It's a smaller part of the portfolio, mid caps and small caps, especially mid caps, right? I mean, small caps is not that big a part of the portfolio. It's really mid caps. That's why we take some active risk relative to benchmarks, things like that. I think that it'll be nice to see that thing come back.
One other comment. I mean, we can go all day. I need to wrap this up. I've seen data, and I need to confirm it, but I think it's probably accurate, the sources I've seen. Small caps usually don't start to rally until the Fed actually cuts. Remember, we had that blip back. I get choked up talking about small caps. We had that blip November, December, 24% rally on the Fed was going to change. Fed was going to become dovish. Fed was going to start cutting. And then, that wasn't the case. And we've had a flat 6 months. So just be aware, we think cuts are coming. History says once they start cutting is when small caps start to outperform. So maybe we're going to see that sooner than later. All right, Sonu, anything on the week you're watching? And then let's wrap this thing up.
No, I think CPI. Inflation is what I'm watching. And then I'm going to be watching how many people are reading.
Sports.
That's the Euro Cup is on. India just won the World Cup. So it's been a good summer. Wimbledon final week. So a lot of stuff happening.
And then the Olympics start.
Yes.
And you always see those studies, like obviously it's in Paris this year. Like, what does it do for the GDP? Yeah, you see a spike. I mean, you see a spike in GDP in the home country. I don't know if the stock market does better. We wouldn't blindly invest in something like that. But hey, this summer keeps going.
A lot of things happening in France.
Well, if you're under 26 years old, apparently you don't work this summer. You're going to France. I mean, like nobody under 26 years old, but it's, everybody's worried about a recession, but they're over, asking
Everyone's
how they're
traveling though.
Everyone's traveling, man. That's right. All right, everybody. Listen, we're going to wrap it up. We'll be back next week with another edition of the Facts versus Feelings podcast. We appreciate it. This was episode 92. Here's our mid-year outlook. Please, again, go to carsongroup.com/outlook, check it out, and sign up for the live version of the outlook discussion with Sonu and myself in a live. I think it's Zoom. I don't know who
Zoom.
It is actually. It's Zoom. Either way.
No, I think it's go-to webinar.
It might be go-to.
Yeah.
Either way, doesn't matter.
Our
Doesn't matter
favorite.
for you guys. We'll be. Yeah, no, boy, I always get nervous using that. He's
Sorry.
like once a year. He's
No
like once a
offense.
year. Yeah. Either way, whatever. Just sign up. We'll be there. We'll talk about all this stuff. It'll be a lot of fun. So everyone have a great week. Enjoy the summer. Hopefully a lot of people taking some vacations. If you haven't already, summer's winding down. I'm not going to say winding down. That's a strong way to put it.
Don't say that.
There's still, I'm not going to say. There's still time, but book those vacations. Live your life. Have a little fun. It's a bull market. Economy strong. And Carson Investment Research will be there for you every step of the way if you need us. Let us know how we can help. Email us at factsversusfeelings@carsongroup.com. See you by next week. Thank you. Goodbye.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.